It was a relatively quiet day on Wall Street with the S&P 500 down just 0.38%. After several days of 1 and 2 and 3% moves lower, I guess we'll take what we can get, but it was still the fifth straight day to the downside for the S&P 500, which has only happened one other time this calendar year. It just happens to be right when the S&P 500 hit its all-time high. This time around, hopefully we're a little bit closer to a short-term bottom, and of course tomorrow is a key interest rate decision by the FOMC, so that has the possibility of moving the markets sharply in one direction or another. We also saw that some stocks were benefiting from corporate news here today. Oracle was up nicely off of their earnings announcement, and Fedex raised their dividend by 53%. So we had some nice upward movements there. But other areas of the market, especially utilities and REITs, really struggled with the 10-year Treasury yield spiking tremendously. So we'll talk about all of that in tonight's video. We'll then get into our trade application example where I wanted to feature a put sale on a dividend aristocrat company with no long-term debt. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's June 14th, 2022. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, and then go down below into our description area and make sure you're signed up for our email distribution list. We got a couple of questions via email about that here recently, and so want to make sure that folks are aware of where to find that. So again, if you're ever trying to sign up for our email distribution list, just simply look in the description area of the YouTube video itself. In addition to that, we're heavy users of Twitter. Feel free to follow me at Brandon Van Zee. We really appreciate those of you that click like and retweet on these Market Outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address in the logo in front of you. All right, let's go ahead and jump into today's trade activity. Bit of a quieter day for once. Feels like things have been kind of coming off the rails here in the last 4 or 5 days, but today was a little bit more calm. We did close a little bit lower, as we'll get to in a little bit when we look at the charts. We were down about 0.3%, I believe, on the S&P 500. So makes sense that when we're looking at this heat map here for the S&P 500, looks like we do have a bit more in the red category as opposed to the green. The good news is it does look like the biggest squares and rectangles largely were in the green today. Of course, a couple of exceptions to that. Amazon appears like it was down about 1.3%, but otherwise we got Tesla and Alphabet and Nvidia and Microsoft and Apple all closing higher here today. So I think they kind of pulled their weight a little bit more so when it was all said and done with the final scorecard with the S&P 500 just barely being down today. As I just take a quick glance at this, it appears like there's way more red squares. It's just that they are less important to the overall end result when we are using a market cap weighted index like the S&P 500. In terms of some of our bigger movers here today, you can see that Oracle had a heck of a day. It was up 10% off of their earnings announcement that they came out with yesterday after hours. So that was a positive sign there for the technology sector. And that sector, of course, could use some good vibes. So strong day there for Oracle. And that might have bled over to some of those stocks like Microsoft and Apple and Nvidia and some of those that finished in the green up there in the upper left-hand corner. We also had a strong showing here from Monolithic Power. It was up about 4.5%. Boeing had a nice day, up about 5.44% within the Dow Jones there. Boeing had been struggling, hitting recent lows here within the last week, so good to see a sharp snap back there. And then here's Fedex, and some of you saw me tweeting about this first thing this morning. Fedex had one heck of a day here. First of all, they reported a 53% increase in their dividend. Now, even after that increase, they're still yielding just a little over 2%, so it's not quite as high of a yielding of a company as their competitor, UPS, which we've owned in our dividend growth investing classes many times throughout the years. Fedex has always kind of taken a slightly different pathway where they've tried to build their company for growth as opposed to becoming an income machine like UPS has. But perhaps they're starting to see the light, so to speak, and maybe they will become a generous payer of dividends moving forward. So let's keep our eye on that story. It does sound like there was some potential activist investor involved there as well. So combination of those two things sent FEDX up 14.41% here today, which was actually its largest one-day move since 1986, back when I was a kid, probably in Little League. And so quite an enormous jump there for FedEx. In terms of any other big movers, let's now talk about the downside of the market. Some of the brighter colors I see here, Wells Fargo kind of sticks out. It was down 4%. Some of those other banks were also down today, like JP Morgan, Bank of America. By the way, remember, we do have an open sold put trade on JP Morgan that should expire this Friday. Our sold strike is 105. It's at 114 right now. So I'm going to keep my eye on that. Remember, if you are a premium member of Market Scholars, whenever I place trades for the market outlook videos or for any of my trading rooms, we always send that information out to you immediately through our Telegram channel. So assuming everything goes smoothly tomorrow with, of course, Jerome Powell coming out with an interest rate decision, that could cause some chaotic market movements. So there is a possibility that JP Morgan or any of the other June sold put contracts that we've done could start slipping into the weekend. And if that's the case, I might end up doing some rolling orders and different things like that. So anyway, if you're a premium member, keep your eye on the Telegram channel in case you're interested in any movements that I make on behalf of the portfolio. So banks struggled a bit here today. Some of your consumer staples struggled here today as well. Kind of interesting. Coke had a really terrible day today. It was down 3.4%. And yesterday it was one of the only stocks that was up. So go figure there. But Coke wasn't alone. Pepsi was also down 2%. Procter & Gamble was down 3%. Colgate was down 2.5%. Kimberly-Clark down 2.8%. Clorox down 3%. So pretty ugly day there for a number of those traditionally more boring consumer staples companies. And they weren't alone in that regard. Another boring area of the market traditionally is utilities. And as you can see down below, it looks like to me a clean sweep of selling in terms of all of the utility components in the S&P 500. Everything from larger to smaller. If you were a utility and in the S&P 500, it does appear that you closed in the red here today. So some of the more popular names, of course, NextEra Energy was down 1%, Duke Energy was down 2%. Con Ed was down 2.6%, et cetera, et cetera. So interest rates are a big story there. Remember that the 10-year Treasury yield has been spiking dramatically. Some of you saw my tweet a little bit earlier talking about how the 10-year yield is in the midst of its greatest 5-day rally in many years, I think since going all the way back to 2008. So this is not a normal yield environment we find ourselves in right now. It is an extreme yield environment that we find ourselves in right now. So remember, all else being equal, utilities and REITs are interest rate sensitive. And so when interest rates spike, all else being equal, you should assume that utilities and REITs will underperform on a relative basis. And that is what we saw here today. In fact, the weakness in the REITs here in the last week or so led us to be motivated to actually buy a REIT in my dividend growth investing class earlier today. And that recording is now posted. So if you're curious what stock we ended up buying there, or what REIT I should say, feel free to check out the recording if you're a premium member of Market Scholars. All right, let's go ahead and pop on over here to the normal part of the platform, get a sense of the numbers of the market breadth. And as you can see, I've got the S&P 500 pulled up here under the visualization index watch. And we did have 173 stocks closing in the green today, which is good for about 35%. So you can think of it as approximately 1/3 of the components in the markets did close in the green. 2/3 of components within the S&P 500 closed in the red. So again, while we look at the charts and we see here that the S&P 500 was only down 0.38% here today, which is not that violent of a move, 2/3 of the components were in the red. So again, I think it was Apple and Microsoft and some of those bigger market cap companies that kind of offset some deeper weakness that we actually did see when we look underneath the hood. Real quick here on this chart as well, I just posted this on Twitter a little bit earlier today as well, but in case you're not following me there, I thought I'd bring it up here too. Keep in mind that I usually only bring this chart up if we have a move of more than 1% up or down. Today was not one of those days, but I still wanted to bring this up because I wanted to point out something that was somewhat rare that's sticking out from a statistical perspective here. Notice that today was actually our 5th straight down day in the S&P 500. These prior days obviously were much more difficult, gapping lower to start the day and then continuing lower to close near the lows. Today didn't give us that same feel. Today was not all that panicky. Today kind of just was stopping the bleeding, so to speak. Nonetheless, we did close lower, so that's our 5th straight red candle that we see there, where we started somewhat high, ended somewhat low. And one way to kind of identify streaks is by using this middle area of chart 6D. Remember, for those of you that are premium members of Market Scholars, you get access to all of those different charts that we use for our presentation. So you can follow along with this while you're watching, our analysis. But, a lot of times I try to point out the big movements of those bars down below. Today was not one of them. Today I want to just point out the count of them, because sometimes it's hard to actually squint your eyes and look to see if it was an up day or a down day by looking at the candles up here, and it sometimes is a little bit easier to actually count days by looking at this middle area of the chart, and so it's a little bit easier for you to see that this was indeed the 5th straight down day. 1, 2, 3, 4, 5. And if you were to go back throughout the last year, remember this is a 1-year, 1-day chart by default. You can always go and change it if you need to, but when you pull up chart 6D, it comes up and looks at the last 1 year. And I had to go back in time to see when was the last time we had 5 straight down days, because that is not normal, right? Obviously, a couple of days in a row to the downside is normal, just like a couple of days to the upside is normal. But having 5 days in a row of consistent selling or 5 days in a row of consistent buying is pretty rare. And so I actually had to go all the way back here to this time period right when we started the year. In fact, what made it somewhat unique is, as I kind of pull this down just a little bit, I wanted to show you where the high label was on the S&P 500. It happened to be on January 4th. We might not have known it at that time, but it actually was the 2nd trading day of the year that ultimately became the stock's all-time high, which we've now fallen 20% from with this ETF that tracks the S&P 500. Or actually, this is the index itself. But you could pull up SPY and have the same type of analysis. Point being, the S&P 500 had its all-time high the 2nd day of this calendar year. I know it probably doesn't feel like it. For a lot of us that have been suffering through these downtrends this year, it kind of feels like it's been a long, long time ago since we had an all-time high. But it was actually this calendar year. It just so happened to be the 2nd day of this calendar year. But notice that on that day, we did finish a little bit lower, or at least closed lower than the open. And so down below here, notice that we have a little red bar. It's hard to see it. I get that, but you can count, on the area right there on the black. I guess if you kind of squint there, you can see whether it's a red or a green color. So even though it was a very small day, we did finish slightly lower that day. So that would be 1, that would be 2, that would be 3, that would be 4, that would be 5. So starting with the all-time high, we actually hit an all-time high on an intraday basis, closed lower by the time we closed, which was the first of 5 days in a row to the downside. And of course, that's what's led us to this terrible moment in time. So kind of interesting that this is only the 2nd instance of that here in this calendar year. And of course, hopefully we're a lot closer to a low at this point. Back here, you might have looked at that and said, okay, well, that is a precursor of negative things to come. I don't think I would necessarily interpret the current state of the markets in that same regard. I think we've taken a lot of damage already. We're probably closer to a shorter term bottom. In fact, it's possible that tomorrow we get it. Now, I don't know of that to be an absolute fact, of course. I don't have a crystal ball, but the conditions are there to make that a possibility. Remember when the markets were falling during this period and then had this kind of miniature bottom here on May 20th, and we pointed out that long lower shadow right there, but we also pointed out that it did not come with a volatility spike. And so it was a little too orderly to actually have confidence that that was the low. And so you just had this kind of precarious feeling as we started bouncing from those levels that it's good that we finally saw the bulls come alive again, but it just didn't feel trustworthy, which is part of the reason I did those bearish trades back-to-back sessions here a week or so ago, because I myself did not believe in this particular rally. I was hopeful that, we could catch a little bit of a bid because we were oversold with 7 weeks in a row, but I certainly did not think that was the low, and then all of a sudden we're going to be in a trend-changing rally. And part of the reason why I refused to, give in to that temptation, because remember, some people were saying, yeah, that was it, we're going to be off to the races again. But in the back of my mind was just lingering. We never had that capitulative moment where the VIX spiked. And who knows if we'll get it, but tomorrow with the Fed speaking, a lot of times we do get very volatile price action. And if, we wake up first thing in the morning and markets are pointing lower and we're down 2 or 3%, and then, Jay Powell comes out and says something the market likes and we end up closing positive by the day, and that's included with a VIX spike, then I think we can have some constructive activity to work off of. The other possibility is maybe the markets get it wrong initially when the interest rate announcement is made by Jay Powell, and the markets just rocket lower before then catching their breath and then, closing maybe in the green or positive. So there's a couple of different possibilities there. And again, you don't ever bank on that actually happening, because the chances of, any day having a 3 or 4% range is very, very low. But again, because there is a known event where previously we've seen lots of volatility, at least the kind of weather conditions are ripe for that type of a scenario. So let's be on the lookout for that possibility there. And of course, since we're down 5 days in a row already, there's a decent snapback possibility, right? You can only stretch that rubber band so much before the people on the other side of the trade need to get paid as well. So you could have a quick little snapback there if things get too ugly. It might be one of those situations where, it's so bad it becomes good. So we'll keep our eye on that possibility. But remember, tomorrow, a big, big day there for the Fed announcement. And the expectations as of this moment in time is that the Fed is actually going to raise 75 basis points. Remember, a week ago, the expectations were only going to be 50 basis points. But just like that, with a snap of the fingers here yesterday when rumors started floating around, it's almost assured that in the market's eyes that a 75% or a 75 basis point increase will occur there. So we'll see if Jay Powell walks back his previous statement where he said that was not on the table, because right now the market believes it's very much on the table. In fact, it's kind of the default pathway at this moment until we hear otherwise. So anyway, 5 days in a row to the downside for the S&P 500, somewhat of a rarity. The last time it happened was as we started off this year and as we really started off this downtrend about 6 months ago. Let's go ahead and move along now to our traditional 4-grid charts. And as you can see here, not a lot of promising developments in terms of postures. We remain with strongly bearish postures in all of our charts. In fact, with the Russell 2000, we just went to a strongly bearish posture because of today's fall. Yesterday, we were in a weekly bearish posture with that lighter color of pink there, but today, notice the transition there to the darker pink background color, joining the other 3 indices that were already in that darker pink coloring. So you can now see, with the benefit of hindsight, of course, that these oversold cluster signals here on the S&P 500's daily candle led to the reversion to the mean. But just like we remind you regularly, do not get overly excited when you see that, because it doesn't necessarily mean that it's going to be trend changing. What we need to do is actually conquer the 30-day moving average and build up from that. And we just simply were not able to do that in the markets here. And so, those oversold cluster signals led to some sort of a blow off the steam moment by reverting to the mean, but it wasn't enough adrenaline to push the markets into a new direction. The direction stayed the same. Remember, that likely is the outcome for most clusters. Most clusters are going to tell you that the blue line, the red line, the green line are all in the lower reversal zone on the same day with an oversold cluster signal. But remember, part of that is the green line, and the green line is saying that the intermediate term trend is bearish. So when we snap back from those levels, you still have bearish charts in many cases unless you develop a lot of time above a moving average. And this one was a little bit better than some I've seen in the past. Nonetheless, even a week and a half here where we kind of hugged that moving average line just wasn't enough for us to kind of fall back into that downward trend. And so that really was the story with all four of our charts, with the Russell 2000 doing the best to try to make an attempt to change a trend, but just wasn't successful in its efforts. What I can say with the Russell 2000 is at least you got a green bar there on the moving average for one day. It didn't last long because it just happened to be right at the start of this 5-day reversal here. But at least when the moving average bent higher, it was a sign that there was enough strength from market participants to kind of bend that, like, you know, a steel beam or something. It takes a lot of pressure to move a moving average higher. And because there was a more significant bounce higher in the Russell 2000 off of its lows, it was able to actually bend that steel there. Whereas these other lines up above, notice that those moving averages did not ever have even a hint of green. They were always red or yellow. Telling us basically that the moving average direction never changed. It continued to be downward trending 30-day moving average despite the stock market trying to rally the candles at least up to the moving averages themselves. So, that's a couple of different ways that you can kind of think of the Russell 2000 as making a valiant effort, but then ultimately failing at that, right? And that was something that we discussed there as well. The idea that the Russell 2000 became a leader, but it was only a relative leader. It was not an absolute leader. In other words, there's always going to be one entity that is doing better than the other, or in some cases, losing less than the other. And that is, the idea of relative strength versus relative weakness. But when market conditions are bad, as they have been here lately, even relative strength doesn't lead you down the pathway of gold and riches, right? It still means that you have more selling than buying. It's just that you're taking less shrapnel than you would be in other areas of the market. So as we look at these four different charts here, the S&P 500, as mentioned before, was down 0.38% today. That green intermediate line has nearly entered back into the lower reversal zone. And remember, if it would have done it today, it would have been another oversold cluster signal, and it would have formed a little green dot like we saw back here because we did have the blue and the red lines in the lower reversal zone. In fact, that brings up another point that I wanted to make. Some of you saw me mention this on Twitter as well, but for those of you that don't follow me there, be aware that if I were to change this chart, so I'm going to maximize it here so you can see it a little bit better. So we're still looking at the S&P 500 index. If we were to change this chart from a daily aggregation period to a weekly aggregation period, so let's just pull up, a 3-year, let's actually do a 5-year weekly because I want to prove a point. So a 5-year weekly chart here. Notice where things are right now. We actually have a green dot showing up on the weekly candle chart, right? We just barely missed it on the daily candle chart today, but we've had dailies oversold cluster signals here, a couple weeks ago. But, the pressure has continued to build to the downside on the S&P 500 to the point where we actually, at this exact moment in time, have the green line, the blue line, and the red line all below 20 on the same weekly candle, thus producing this oversold cluster signal. And remember, all else being equal, those weekly oversold cluster signals are much more rare than daily cluster signals. And you can see that when I pull up a 5-year weekly chart like I have here, we only have one other instance of that in the last 5 years, and it happened to be right during that devastating Christmas time period in 2018 where markets just got hit really hard very, very quickly for that 1 week while a lot of people were on holiday break. So you can see that back here in late 2018, that would have been a brilliant time to be buying stocks and fading the selling. So again, going back to my earlier comment about us being down 5 days in a row, but how it feels tremendously different than when we were down 5 days in a row to start the year when we were close to all-time highs. This is yet another sign that we're probably getting close to some sort of a short-term bounce opportunity here sooner rather than later. Even if you went back, by the way, and went on a 10-year weekly candle chart, you still only had that being the only instance of it. So again, very, very rare that at this exact moment in time, we have an oversold weekly cluster chart on the S&P 500 index. And this is only the second example of this in 10 years. Now, one thing I should mention is it's only Tuesday. And so if we do get a rally between now and Friday's close, it's possible that this green dot will go away and there is not actually a oversold cluster officially in the books, right? This one back here is officially in the books because we're now past that aggregation period. This candle that we have right now is only the accumulation of Monday and Tuesday's trading. So if the rest of the week we rally and we actually close higher on the week, then it's almost assured that that green dot will go away. But just giving you a heads up, just in case it does end up that way, to kind of leave the impression of how rare this is and how extremely oversold some of these markets are getting. And, it's not alone. Obviously, when the S&P 500 itself has a weekly oversold cluster signal, remember, many components within the S&P 500 also have weekly oversold cluster signals. In fact, one of them I will discuss a little bit later on in tonight's video as our trade application example. All right, let's go back over here to our normal view and go back to the foregrid here to kind of wrap things up. The Dow Jones was down 0.5% today. It was also down for its 5th straight day, and as I mentioned before, also has a strongly bearish posture. The NASDAQ composite in the lower left-hand corner was actually up today, so that's a good sign, right? That tells us that risk-taking wasn't just completely thrown away. And remember, that was being called into question here yesterday because of everything that was going on with Bitcoin, cryptocurrencies in general. We're just getting smashed. And so it is a positive sign that the NASDAQ composite did close higher here today. So notice that we have a black candle there as opposed to the red candles on the other 4 charts. And therefore, the NASDAQ only had 4 days in a row. They did not officially get a 5th day, even though we did hit a new multi-year low here today. On an intraday basis, we ticked lower in the middle of the day, but then actually closed just a touch higher by 0.18%. So maybe a small element of hope there for the markets with that tech-focused index of the NASDAQ really benefiting from NVIDIA and Microsoft and Apple and Tesla and Oracle and some of those tech-oriented companies that are on that exchange there. But, it doesn't change the fact that we still have an intermediate, strongly bearish posture. And the green line in this case is very, very close to entering back into that low reversal zone. It's at 22 and falling. So that would have been kind of interesting if we had an up day where we would have still ended with an oversold cluster signal. That can happen. In fact, it happened right there, but it would be pretty rare for that to occur as well, just to go to show you how bad the selling has been in the week previous to today for the NASDAQ. And then with the Russell 2000, it did close lower today as well, but it actually outperformed the Dow Jones Industrial Average. Russell 2000 was only down 0.39%. Had a little bit longer of a lower shadow there, maybe more of a spinning top type of a candlestick formation there. Notice the difference in the green line versus the other indices green line. This one, you've got a little bit of extra space there, right? There's a bit of a gap between the green line and that black horizontal lower reversal zone line there. So it's another way to kind of identify, at least directly through the lens of the market forecast technical indicator, that the Russell 2000 is holding in there a little bit better than you might have expected given the circumstances. Because remember, normally Russell 2000 is more speculative, but it's actually done a reasonable job of trying, scraping and clawing its way to sideways price action here more than anything else recently. And that's saying something in a market that has a path of least resistance that is, feels like it's straight down in certain other areas of the market. All right, let's go ahead and step on over here to the internet briefly. I always like to get a chance to say thank you to those of you that help support these market outlook related posts and videos and everything else like that. So remember, we generally will pin our most recent market outlook video to the top of our timeline. So David will pin his most recent one and I'll pin my most recent one to make it easy for you guys to go and like it if you so desire. Remember, you can also like it while watching the video directly on the Market Scholars website with the little widget directly below the video. And then you can also find the tweet in question in the description of the YouTube video itself, and then also on the emails that we send out to you. So any one of those 4 ways would allow you to help support this presentation, as it is something that does soak up a lot of our time, and we want to make sure that it is time well spent. So thank you to the 128 of you that did click like for me last time. As I always say, as long as we're up and over 100 likes, I'm happy to do a full-length video that includes a trade application example. If we're under 100 likes, then the enthusiasm isn't quite there as much, and we'll try to keep it shorter for you at only 15 minutes without a trade application example. So again, tonight is a full-length video as a result of you guys stepping up to the plate and clicking like there for me. So I always like to get a chance to put your name on the scoreboard, so to speak, and thank you individually. So thank you to Arth, and thank you to Evan, and Lucius, and Sophia, and Jayesh, and Mark, and Jeanette, and Michael, Sarah, Walter, Fired Up Wealth. Kind of funny story about that. This fella here grew up about 45 minutes away from me, probably even less than that. And I didn't even know the guy. We just happened to meet, not meet, but see each other on Twitter, kind of talking about some of the same types of stocks and things like that. And, the conversation led from one direction to another. And little did we know, we both grew up within a very small area in the middle of nowhere, South Dakota. And there's a pretty good chance that we actually played each other in sports in high school. So, small world out there, kind of fun about the internet. You just never know who you'll meet. So he seems to know his stuff in the world of investing as well. So thank you for the like there. Thank you to Dave. Thank you to Doji, David, and Pam, and Catherine, and Jim, and Sedona, and Austin, and Venki. Venki knows his stuff as well. There's Val, Prickly Trader, Deborah, Violina, TS, Claire. Too many to go through one by one, but I see ya. I appreciate ya. Please keep that up. It goes a long way with both David and I. So thank you to all of you supporters out there. Also, as I mentioned earlier today, I did teach my dividend growth investing class, and so you can find that up here in our trading rooms area on our website if you're a premium member. So feel free to check that out. That has been recorded and is listed right there on our calendar. And then last but not least, let's take a quick peek here at the Sector Selector. A reminder that the Sector Selector gets updated on Friday evenings. So it is a couple of days stale by this point when I'm with you here on the video on Tuesday night. Remember, I actually do this this tool mostly for my Monday morning class, my top-down trend trading class, but also get a chance to review it oftentimes with you guys here in the YouTube video. Not a whole lot to discuss this week, quite frankly. We still have the same bookends that we've been dealing with, where energy stocks have outperformed most other sectors out there. I sound like a broken record there because I am. It's literally been months and months and months of energy beating all other sectors that are out there according to our relative strength ranking system that we use here, known as the WAR score. On the flip side, consumer discretionary is dead last for the 4th straight week. And remember, they were dead last back here about 3 months ago for 4 weeks in a row as well. So they're no stranger to being at the bottom there, as this has really started to hit a lot of retailers and other areas that if we do get an economic recession, naturally it's the conversation of the wants versus the needs, right? Consumer staples would be your needs. You can't get by unless you're buying food and beverages and things like that. That's how you live. So you'll find that the consumer staples will still have an active audience even if the economy is in the toilet, because we all have to eat. On the other side of the equation, you don't need to go out and buy a brand new $60,000 automobile or something along those lines if you just lost your job here recently because of a terrible economy. So a lot of those consumer discretionary names are in the doghouse as a result of a lot of people anticipating that we will see a recession sooner rather than later. All right, let's go ahead and get back on over here to the platform, and let's do some 12 grid analysis now, starting with chart 5A. This is our asset class 12 grid. And as we pull this up here, you can see that we've got a few green charts on the board, and they're all on the bottom rung. It's starting to feel a little bit like it did a month or so ago, where week after week we'd come in here and we'd look at the 12 grid, and it was mostly always the bottom rung that would have any sort of bullishness, and pretty much everything else did not. And so we're back in that mode right now, and it's not a great mode to be in. Remember, it's basically a risk-off type of a mode. Let's talk about the 10-year Treasury here, because this is absolutely insane. Again, going back to that tweet that I had earlier. In fact, since we were on Twitter, I should have just shown you while we were over there. Let me come back and kind of get you the exact numbers here. But this is the part that I pointed out. The 10-year Treasury is the largest 5-day yield gain since October of 2008. There's a lot of other statistics here that are noteworthy as well, but that one in particular really caught my eye. I mean, this has been an aggressive move higher in yields. And remember, it's not just the 10-year Treasury yield. We're seeing that across the yield curve, really. And we even see that the 2-year Treasury yield has spiked substantially. So we're seeing interest rates just going crazy to the upside. And remember, it used to be the opposite. We'd come in here, 3 years ago or whenever it was, and we would, talk about, what's going on with interest rates, and it was the exact opposite. We were talking about how interest rates were just plunging left and right, and how some areas of the world had negative interest rates, and this, that, and the other thing. It's crazy to think how much night and day difference there is right now versus what we experienced there just a couple of short years ago. But here's what that looks like visually from a charting perspective. Let me right click and maximize that. Take a look at those last 5 days. This has been absolutely insane as we've just gone straight up. In fact, it just so happens that we've had 5 days in a row to the upside. But really, if you took away that candle there, we're kind of talking about 7 out of the last 8 days to the upside. And you could take that a little bit further and take that one out, and you could say, 9 out of the last 11 days were to the upside. It's really crazy. This is not normal behavior for those of you who are newer to the markets. You typically do not see this type of one-sided action, especially in the quiet corners of the bond market. But anyway, interest rates are spiking violently right now. It's another sign that the market is taking the threats of inflation very, very seriously. And it's also another sign that, Jay Powell might not be done when he comes out with a possible 75 basis point hike tomorrow. He might need to come out with another emergency hike between now and the next scheduled FOMC meeting. Who knows? But the market is very concerned, is one way to kind of read into that 10-year Treasury yield just exploding higher right now. So naturally, when you see that type of behavior, you should not be surprised to learn that the 10-year Treasury yield has a strongly bullish posture at this moment in time. Its intermediate line is at 87, well into the upper reversal zone. And of course, the 10-year Treasury yield Yield moving average itself has now started to curl higher again. Remember, we had that little moment in time here maybe 3-4 weeks ago where it really took a rest and started to give us, it started to actually make us question whether you were going to break down on the trend. We now know, of course, that didn't happen. It spent maybe a week and a half below the moving average there, but it never really collapsed. It just kind of hung out a little bit below the moving average. Now it is surging once again to the upside. Off on the left-hand side here, you'll see that the dollar is much in the same vein. Remember, both the dollar and the 10-year Treasury yield both fell at the same time. They both fell from overbought conditions back in kind of underneath that rising 30-day moving average. And then for the last week, week and a half, they've both been surging back higher. And we do see that on occasion throughout history. Keep in mind that there's always a trade-off mindset or conversation that needs to be had with global investors. And sometimes we do find that to be the case, that when the United States government is offering a larger than average yield for government bonds, and that's effectively what we're talking about here, right? The 10-year Treasury yield. You move that decimal point over 1 to determine what the interest rate is. And right now, we're talking about a 3.48% interest rate. And the crazy thing about that, I was talking in my morning class this morning about how the 10-year Treasury yield was about ready to touch 3.4. That was this morning. So we went up an additional 8 basis points just by the closing bell. I mean, this thing is just taking off to the upside. So when you're an international investor and you might be in some other far-flung corner of the world and you're trying to determine where do you want to put your so-called safe money in, government bonds, and you have available government bonds from all kinds of countries all over the place. The United States, of course, is noteworthy for being a very liquid and large market, but it doesn't always have the highest yields. A lot of times the higher government bond yields come with some of the riskier areas of the world, and that's still somewhat true. But if you were to kind of look at the developed area of the world and look at the United States versus, let's say, Europe or Japan or what have you, there's a pretty good trade-off argument that could be made that the United States is a decent place to be parking your money if you're an international investor, because you're going to be offered 3.48% on that 10-year Treasury yield that once upon a time was below 1% not too long ago, just a couple of years ago. And so if that happens, then those international investors will need to trade in their rubles or their yen or their rupees or wherever they happen to be for US dollars. They got to go and buy US dollars in order to do that and then make that transaction to buy those US government bonds. So sometimes those two things do play hand in hand with one another, and we're kind of witnessing that play out right now. Remember that all else being equal, when the dollar is strong, like it has been here lately, this is the 5th day in a row to the upside for the dollar. Now, that should sound familiar because I just got done saying how the S&P 500 is down 5 days in a row. And remember those comments I've made to you guys over time that I personally believe it's easier to operate as a stock investor in a falling US dollar environment. This is proof in the pudding right here. The S&P 500 has been down 5 days in a row when the US dollar has been up 5 days in a row. For those of you that are on an international vacation right now, hello to Irene, who was in class with us earlier today, who's out in England right now. She resides in the United States. She's probably, letting her money spread out a little bit more than she would be able to otherwise. So I guess that's the one good thing, is that if any Americans are planning an international vacation here soon, you're going to be able to get more bang for your buck there. But that's only one small, minor convenience. The truth of the matter is, I think a lot of people would like to see their stocks going up again. And we might very well need the US dollar to cool off if that is to be the case. That sometimes works hand in hand as well, not only because the US dollar has an inverse relationship with commodities, but remember, also an inverse relationship with businesses that do a lot of business overseas. And that means foreign stocks directly, but it also means the multinationals that the U.S. is known for, stocks like Procter & Gamble and Coca-Cola and some of those that I mentioned before. Perhaps that was the reason that they really struggled here today, is because the U.S. dollar is starting to surge, and they're all else being equal, when they need to bring those profits back to the United States, it's going to look like it's less profits because you have to convert your euros and your your yen and everything else back into a stronger U.S. dollar, it's going to appear that your sales were softer or weaker overseas. So that does play a little bit of a role there as well. And then there's always that trade-off mindset. Remember, the U.S. dollar is oftentimes viewed as kind of a safe haven currency. And so when we have kind of a risk-off day in general, where you see, a lot of stocks falling, sometimes investors just move out of stocks in general and then move that money into where they perceive some safety there. So a lot of different things at play there. But generally speaking, when you see this bottom rung as our only green charts on the board, it's not a particularly healthy moment for the markets in general if you're looking for the markets to take risk. Now, that can be pushed too far, and again, that's the hope, is that with things being so ugly across the board, that in the short term, we should have a decent chance at a snapback rally. It's just that the chances of that being it, and that being the end of this really terrible 20% pullback, is not quite all that strong, in my opinion. But, that can change, and that's why I want to stay open-minded around that point as well. I want to see the evidence unfold in front of me, and hopefully that's what many of you do when you approach the markets as well. So let's talk about oil here real briefly. Oil was down 2% today. There is a story going around that President Biden will be meeting with Saudi Arabia. So there's maybe a possibility that oil was down because the dollar was up today, but also maybe there's going to be some more supply of oil that will hit the market. If there's more supply, then price needs to correct itself to the downside if demand holds steady. So maybe that played a role today as well. But don't kid yourself. This is still a very strong chart here for oil. So yeah, it was down 2% today, but if you're looking for good-looking charts and strong trends, this is one of the only places you can find that. So, you got to kind of let the chart breathe, so to speak. Whereas gold still looks just downright awful, which is, kind of crazy. You would think that this would be the type of environment where gold would do well, and the market's just saying that's not right. And so it's frustrating because my mind tells me that gold should do well right now, but the markets are clearly telling me that my mind is wrong. And maybe we don't know the reason it's wrong yet, but what we can do is look at this chart and we can clearly see that it struggles much more often than it is finding success. And in the last couple of days, we're slipping yet again, and it looks like you're kind of just rolling over from that downward trending 30-day moving average. So gold does not look to be the traditional safe haven in this current moment in time. In terms of some of these other charts, with interest rates surging today, you guys should not be surprised to see that the 10-year, not the 10-year, but the long-term U.S. Treasury. So that's usually kind of in the 20 to 30-year range. When interest rates go up, all else being equal, bond prices go lower. And so TLT was down 1.26% today. That's actually a new multi-month and probably multi-year low there that we're looking at. And it did close with an oversold cluster on the daily candle chart. Let me right click on this because I'm curious for myself. I don't know if you would change this to a weekly. If it does have it, it does. So I'm glad I checked that because I wasn't sure of that. I knew it the S&P 500, but I guess I wasn't necessarily for certain that we closed with an oversold weekly cluster on TLT here as well. But that is the case as of this moment. Again, same thing. It can change by Friday, but as of this exact moment in time on Tuesday, you do have an oversold weekly cluster here. The problem with this is, oddly enough, for as boring as bonds traditionally are, you can kind of get away with saying this is a little bit more of a boy who cried wolf. Sometimes you'll hear me use that parable or that phrase of the idea that if you have too many clusters and they rarely work, then who's to say that you should trust the next one, right? With the S&P 500, we only had one other example in 10 years of that. So I still feel like that's a little bit more trustworthy. With TLT, we've had so many of these oversold cluster signals here in the last 6 months that it's getting harder and harder to trust every successive one that might come up. And so be aware that we are at multi-year lows for TLT. This is a 5-year chart that we're looking at. This is the worst that it's been in 5 years. Let's go back on 10 years and see how that looks. And we're nearly at decade lows on long-term bonds. we would have to go all the way back here to about February of 2014 since we saw TLT trading lower than where it is right now. So could that, end up being a level of support? Possibly. Technicians will look at that and say, well, people were willing to give the U.S. their money, the U.S. government their money, in exchange for a certain interest rate at that level back here in 2014. Who's to say that couldn't happen again? So we are approaching that kind of decade low here. You never know when that might end up being a bit of a support area. What we do know is that these prior support levels did not hold. So, you have to be honest with yourself around that concept as well. But I do think that the trade-off effect is becoming a little bit more enticing. We actually talked about this a bit in my dividend growth investing class here today as well, where, it used to be pretty obvious that, you didn't want to go into the bond market because the interest rates there were just not attractive enough to tie up your capital. And so it was pretty obvious that you'd rather get into, let's say, a REIT or a utility or another high-yielding dividend stock, as opposed to getting into a bond with that portion of your capital. Today, if you fast forward to where we're at right now, that's not necessarily the case anymore, right? The 10-year Treasury yield at a 3.48% is a reasonably attractive offering. It's still not like, screaming, value opportunity or something along those lines, but it is tremendously more attractive than it was just a few short years ago. If I were to right-click on that chart and go out to a 10-year weekly candle chart, right? We're talking about just 2 years ago, we were way down here when, and this is unfortunately it's a percentage chart. So let me do this for a second because I kind of want to make this point. I come over here to just a normal swing trading chart where it's based on prices, not percentages. And I'm going to pull up TNX. And I want to go back on a 10-year weekly. And I want to show you that back here, where you see that this low tag was, it says 3.98. Remember, you moved that decimal point over to the left once, and it effectively means that you back here in March of 2020 were willing to give the U.S. government your money for 10 years, and in exchange, all they would give you is, 0.39%. We're not talking about 3%. We're talking about 0.39%, close to zero in exchange. That's how much people were clamoring for treasuries back then, for the safety of treasuries. Now, that was during that coronavirus time period as well, so that could play a role. Remember, bonds, went up as a safe haven trade, and therefore their interest rates went down. But this is what I was trying to stress to you before. This is a night and day difference. We went from 10-year lows on yields here in March of 2020, just 2 years ago, to 10-year highs in just 2 years' time. So it has been extreme. So back here, if you gave the U.S. government your money for 10 years, they would only give you 0.39% interest in return per year. Today, if you gave the U.S. government your money, they will give you 3.48% interest in return on a yearly basis, which is viewed as pretty attractive versus a lot of dividend stocks out there these days who have yields much less than 3.48%. So times have changed tremendously, and the old phrase of there is no alternative, or TINA, has definitely been changed, as I mentioned on Twitter here over the past week. There is now an alternative, and government bonds are a legitimate part of the conversation once again, whereas once upon a time, just 2 years ago, they were basically a joke. People in their right minds typically would not allow their money be tied up for such a long period of time. Now, there are people doing it, right? That's why the interest rates were down there. But a lot of times they were mandates from pension funds and different things like that, insurance companies that are forced to buy bonds as opposed to stocks. You and I, we have a choice. We can choose to buy stocks or bonds. We don't have any sort of a mandate or some sort of a objective or some prospectus that we need to abide by or something along those lines. So this was not rational. People who were buying bonds back here 2 years ago was not rational. I could get away with saying that you are more rational if you're considering it here today. Anyway, be aware that on the remaining 12 grid there, the foreign stocks were somewhat struggling as well. But another thing I wanted to point out, I don't know if we'll be able to see it on EEM, but I did make this point on Twitter here earlier today, so it's probably worthwhile pointing out to you guys here on the video as well. Notice that EEM was actually up today. And a big reason behind that was Chinese stocks. Back over here to Twitter, I think I even made that comment that with Chinese stocks, let me see if I can find it so I can gather my thoughts a little bit more appropriately here. There we go. So on Saturday, I was going through charts, and as I always do over the weekend in preparation for my Monday top-down trend trading classes. And one thing that caught my eye is that I said here, I should also mention that there's a noticeable rise in the relative strength rankings of Chinese stocks versus US stocks. It was a little bit peculiar because I hadn't really noticed that. Yeah, I've seen, the days when Alibaba was up huge or what have you, but I really wasn't seeing it being consistent. It still felt a little choppy. This past weekend was a little bit different. It was noticeable, right? That's why I use that word. It was noticeable to me and the routines that I do every single weekend that Chinese stocks are starting to outperform again. And a lot of people are not paying attention to that. They're so caught up in the massacre that's happening here in the United States that they're not paying attention to the fact that there's actually some semblance of strength in the Chinese securities. So yesterday morning, I talked about that concept in my top-down trend trading class, and we used our stock selector tool. And remember, the stock selector you can also find up here if you're a premium member in our tools area of our website. And I pointed out how Pinduoduo was number 1 out of 1,000 stocks on our stock selector tool. And that was a little bit odd to me because that had not been the case. Previous to this week, it had mostly been energy companies that were up there in the number 1 slot. So all of a sudden, you have this random Chinese internet company that overtakes a whole bunch of energy companies. That was over this weekend, right? Because I do the stock selector updates the same time I do the sector selector updates, which is basically Friday night. So I wouldn't have known what was going to happen in advance on Monday or Tuesday. So we actually talked about Pinduoduo yesterday in my top-down trend trading class. Fast forward to today, and I had to do a double take when I looked over at some of the bigger movers of the market because Pinduoduo was up 10%. Now, they actually ended up going up more than that. This was in the middle of the day. But, it's worth kind of paying attention to those little movements there. And that's why David and I try to teach you guys on Twitter between our presentations. We don't stop the teaching, so to speak, when we stop our presentations. We want to continue those conversations with you guys if you're open to following us on Twitter, because we want to point that type of stuff out because it could be valuable information. It could be the difference between a winning trade and a losing trade for you at some point in the future. So that's one thing I also want to point out is keep your eye on China. China is starting to see some positive movements with their stock market. You might have your own opinion about how their government handled COVID and what you think of their policies and this, that, and the other thing. But what we care about here is what's happening to their stocks. And their stocks are starting to perk up here all of a sudden. So keep your eye on that possible theme there. I personally believe that's why we're seeing EEM outperform EFA. The emerging foreign stocks is where you're going to find those Chinese companies. And no surprise, you are actually up over 1% in the emerging markets today, whereas the developed foreign stocks were down nearly 1%. Real quick here on our sector 12 grid now. Be aware that we're in a struggle here once again, and we have all pink charts across the board. But I would just merely point out that energy is the only one that still looks like it's in an uptrend. And energy is trying to establish a new support level right here at the 30-day moving average. Don't be surprised at all if it were to bounce from these levels. It was actually up 0.19% today. Otherwise, it was a pretty ugly day in some other sectors. In particular, utilities fell off of the board here. 2.5% to the downside. With interest rates spiking, utilities and REITs are really, really struggling. Those REITs were already somewhat oversold, so you're getting some oversold cluster signals here on this move on REITs. Remember, REITs and utilities oftentimes move in the same direction as one another. But notice this time around, utilities were able to get well up past their 30-day moving average here a couple of weeks ago, whereas real estate only got to their moving average. So we've seen utilities try to catch up to REITs by selling off even more aggressively in the last week, and now they both find themselves somewhat close to the same levels below their moving averages. But because REITs never really got strong, it allowed them to enter into the oversold cluster signals a little bit sooner. And they're not alone. Staples has an oversold cluster signal as of today. So does healthcare. So those defensive areas that were once holding up much, much better have now gone by the wayside alongside the rest of the market. And really, it's only energy that has some semblance of strength at this moment. Now, let's talk about our trade application idea. I'm going to come over here to our dividend stair-step chart. This is chart 2A. And this is what we use in my dividend growth investing class because it helps us establish where we find attractive opportunities. And I wanted to pull up ticker symbol TROW. This is T. Rowe Price. This is a dividend aristocrat. In fact, it's the only dividend aristocrat that is completely debt-free from a long-term perspective. So it's a very strong company. You wouldn't know it by looking at the stock price here recently. It's been massacred alongside so many other financials. But this company has no debt. So even if we do go into a recession in the future, the prospects of this type of a company going bankrupt, I would say would be very, very slim. So we try to buy high-quality merchandise on the cheap. You could argue that it is now cheap. You can see down below here, it's trading at 8.7 times earnings. Right, that's the current PE ratio. Notice in the low PE ratio tag, it's right now. This is the cheapest this company has been in the last 10 years of this chart. It's literally trading at single-digit PE ratios right now. It's the cheapest it's ever been. You also see that you have an oversold cluster signal on the weekly candle chart today, just like the S&P 500. Remember, we already did a sold put on T. Rowe Price in this YouTube presentation back here in, I think, February. I remember it because that was when the Rams were going to the Super Bowl, and T. Rowe Price, of course, their logo has a ram in it, so I was making that point. So we did well with that trade back there. I figured let's try it again. We're already well into the blue zone where it could be viewed as an attractive opportunity right now, but we could also sell a put to try to attain an even deeper discount. So what I did here today is I sold the July $90 put, and we were able to get about 90, actually it was a dollar is what we got in return for that. I usually target a 1% return on risk. So 90 would put us way down here and would basically put us back to where we were in the lows of the coronavirus meltdown there. So high quality dividend aristocrat company, no debt. It's the cheapest it's been in a decade, and it has a technical oversold signal here on the weekly candle chart with that cluster. So I thought it would be an interesting choice for a sold put candidate there. Okay, so that's what I had for you here tonight. Hope you appreciated the analysis. If you did, I ask one simple request out of you. It doesn't cost you a penny. All it does is it cost you 5 seconds of your time. Just click like for me there on Twitter. As long as we're up and over 100 likes by the time I'm scheduled to do this video again on Thursday, I'll plan on doing a full-length video. If we're under 100 likes, then I'll just do a 15-minute version there. Now, also keep in mind, I believe David will be on vacation here for the next week or so, so make sure you check his class schedule, and he might not be doing these Market Outlook videos as often as he typically does on Monday, Wednesday, and Friday. So anyway, be aware of that as well. So until next time, I want to wish you all the best of success with your trades and your investments. Goodbye for now.